Welcome back to the podcast. This episode, we are joined by Mr. Tom MacInnis, CEO of Spark Capital Corp and Southern Pacific Resources. Mr. MacInnis is also board chair of PointBreak Resources, board member of Rok Resources, and sits on the advisory committees for the private equity funds managed by Lex Energy Partners. Previously, Mr. MacInnis was a founder and managing director of investment banking at Tristone Capital and head of energy financial markets and energy investment banking for National Bank of Canada, where he worked on over 1,200 M&A and capital raising transactions representing billions of dollars in value. Among other things, we discuss private energy markets, the Tristone Capital days, and Canadian M&A in 2025. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EVA. EVA is a next-generation analytics platform powered by McDaniel Research and tailored specifically for oil and gas to quickly derive insights that matter to energy operators, investors, and advisors. EVA is the only platform that leverages public data, your in-house operator data, and exclusive data sets interpreted by professionals at McDaniel Research. This combination allows for rapid analysis of the most complete data possible, enabling better decisions around A&D, completion design, and optimal field development. Visit turinganalytics.net to learn more about leveraging EVA to uncover hidden trends, make informed decisions, and stay ahead of the competition. Good morning, Mr. Tom MacInnis. Thank you very much for doing this yet again. I really appreciate your time.
Well, it was an honor the first time and honor the second time. I hope it was consumer feedback that leads you to it, but I'll do my best.
You're a fan favorite, back by popular demand. And I was going to say we should get a tennis match in one of these days too, but upon reflection, I think it would be a bad idea on my part.
No, It's likely not. I call it Winter Club famous. If you ask people about my tennis in the Winter Club, they know who I am. And outside, I guess probably not. So don't look for me on TV.
Maybe one day we'll get a match in.
Sounds good.
For the purposes of today, I thought we could structure the conversation around going back in time on the Tristone days, a perspective on your private company involvement, some capital allocation, and some current events, if that works for you.
Sounds good.
But to go back in time, the Tristone Capital days, maybe for the listener, you were a co-founder, I think, of Tristone?
So Tristone was had different evolutions. So at the very beginning would have been in 2000, like right at the beginning. And George Gosby and myself were at Newcrest Capital and we exited together to start Tristone. So it was really just the two of us, with Kathy Tiberio, who on the miracle she hears this, she deserves recognition. I can remember walking into what our ultimate space was in the Royal Bank building. And I for sure said to George, this is ridiculous. We do not need this much space. And X number of years later, we took another floor. And so the first phase was raising money for private companies. And the second phase was adding technical professionals on the geology and engineering front to work on advisory assignments to provide at the time what we've considered more detailed asset level advice to capital providers and buyers and sellers of assets. And then the next real leg up was the addition of a series of deep reputation and notable capital markets experts across sales and trading, research, and more on the investment banking side, which led to what Tristone ultimately was a full service capital markets investment bank.
We talked about Tristone the first time we did the podcast, but what I was curious was, what was the value prop for Tristone? Because at the time you had Peters & Co., First Energy, Waters & Co., Tudor, Pickering, Holt came along, but I never really got the question out why. What was the value prop?
To me, there's a few different parts of this, but like the Tudor of today I don't really think was a competitor of ours at the time as nearly as much as they do today, much like the banks. Like the banks have all added technical expertise or they have acquired some of the asset advisors of the day. And that's not random. But at the time, whether it was Kobayashi or what became Rundle, which is now in RBC, or whether it was Watrous, which is now inside of Scotia, we felt like there was a window of time to add, again, that technical expertise alongside the investment banking expertise to provide better value. And then the addition of, again, relationship drivers. Tristone, we all had this great idea. The logo of Tristone is like this upside down triangle. It's like, of all these logos we thought about, I still can't believe we settled on this stupid triangle. But the triangle had 3 points, and it was ideas, expertise, and execution. And so that's what we tried to do. We added expertise to drive the ideas and then promised execution. That was really the point of it. So at the beginning, I would argue that it was the addition of the technical expertise. And ultimately, I would argue, and even to this day, it's relationships. It's a relationship business, and that's the driver. And that's not to say it was better or worse than anybody else. Peter's great relationships, First Energy, great relationships, and that's why they did great. Over time, the market moves, right? Whether it's financial crisis or oil price up and down, whatever it is, the market's going to move. And over time, let's say the capital markets business or the investment banking business or the A&D advisory business, it's tough to stay independent. It's tough to stay small. My opinion is the equity business, so raising capital business at any size, I feel like that business should pay all of your bills. So pay your G&A, pay all your people, pay whatever, that should pay for the business. And then your advisory business should be your profit, for lack of a better phrase. That's the way I've always thought about it. So when you have extended periods of time of uncertainty or volatility in capital markets, commodity markets, whatever, you're going to see less equity raised, less M&A, fewer transactions, and that's fine in a short-term environment, right? No big deal. Different types of transactions happen in short downturns. V-shaped recoveries help a lot. There's advisory, problems on the way down. There's equity on the way up. But long trough bottoms become problematic if either your corporate enterprise isn't set up the right way, you don't have the right mix of people, maybe you've got a heavy lift that are older that don't want to take the risk anymore, maybe whatever it is. But it's tough to survive these long troughs. And so the banks today, and I'm going too fast here because there's some things I want to go back and talk about. The banks today offer stability in diversification across markets, across industries, across whatever. And by the way, the balance sheets to survive, not just these V-shaped recoveries, but these long troughs. I would argue, however unpopular, Tristone wasn't set up to survive these long troughs. And while we had these pockets of doing fantastic, for myself, I was able to build a franchise or relationships or a resume or whatever that I ended up moving to National Bank and hopefully history says did well there and added some value. But I don't think Tristone as it was going to survive that period of time. And post-financial crisis, sold to Macquarie. A bunch of those people now are the technical team at BMO, and people have gone off to do other things. But if you asked me at the time, I would have probably put a brave face and say, well, it'll last just as long as Peters and First Energy. And history bore that out, which is fine. It's nothing embarrassing about it. It's just the reality of how it plays. I think what's much more interesting is how the independent competes against the banks and vice versa, and how that's changed to today.
What year did Tristone start?
It was either 99 or 2000.
Maybe one way to say it is that there was enough business to go around.
Well, there's a big part of it. Like there's cycles where there's lots of transactional business and you can't be everywhere. And so there were really strong cycles in the early 2000s. In post-financial crisis, another really strong cycle, and it can cover up for short cycles where not a lot happens. So from, call it 2000 plus to 2007, like that was a great time. Great time for Tristone, but great time for Peters, there was lots to go around. First Energy guys did great, banks did great. Not everybody did great on the same things, but there were lots of different things going on with lots of different companies, and there was ability to lift weight all over the place.
When you first started thinking of Tristone, what was your thoughts on the value prop in the beginning? Was it the technical side that you guys added, or what sparked the idea? What led you to that conclusion that you could start a investment bank at the time?
I won't take any credit for that. George was, I've heard it said, and I probably believe it. Maybe I was too close to it, but you'd say George could sell ice to Eskimos or whatever the right phrase is. But he was a hell of a salesman, but he had a really good ear to the ground on institutional capital and what capital markets were saying. And so he was listening to this feedback from clients, from producer clients, from equity clients around the circle. And at the time, listen, I was just trying to add knowledge, exposure, experience. Tom was not driving the bus at the time. So this was George driving that bus. And in the subsequent years, and again, I'm getting better or more meaningful or bigger, a hand on the steering wheel, but we added partners at the time, and I shouldn't name them only because I will leave somebody out, that came in with overnight resumes. And I remember getting a phone call from a producer client of size asking me, what happened here? Like, why overnight are you guys involved in all these deals and in the middle of everything? And I think the answer to that is the people. If we didn't add great people, I don't think that would have happened.
Because from the outside looking in, like I said, you had First Energy, Peters and Co. and Waters and Co. So it would have seemed like there was no room in the market, but good people and an expanding pie led to a viable business model.
There's a long-standing half joke that says Calgary's been overbanked for decades, and I would argue there was lots of room. But over time, and the market changes, not room. Like today, if somebody said we should start something new, I would say, okay, that's fine, but we have to be very careful about what that's going to look like. Just making it look like other things and being the same, you better have the best relationships on the street.
If you look back on the Tristone business model, what do you think you could have done better?
If you could go back in time, what I would do is add more younger people and bring them along faster. So we ended up being more top heavy than sustainably we probably should have been. But at the time, you're trying to make a profit, right? So you have this as longer term, longer term investment in people to bring along this talent. So when everyone's running around fishing, there's not a lot of people teaching people how to fish. So that sounds great and does great, but now think about generational, and I don't mean like 100-year generation, I mean like 5 and 10-year generation of a business. You need to be bringing people along and then have an opportunity for them when they get to that. And the talent of some of the people that were in Tristone and young at the time are not young anymore, and they're doing amazing things now, but we didn't have enough. And so it's a delicate balance. I didn't know at the time what the right answer is, but you get pregnant with amazing talent doing amazing things. People say, like, look at all the fish we caught today. Be like, let's catch more fish tomorrow. Spending a lot of time saying, oh, let's think about 10 years from now. And to survive that business, and I don't want to pick on anybody, but there are long-standing leaders in investment banking lore that I think would be lauded with being a long-term thinker.
What did you guys do right? It sounds like it was the people side. What did Tristone provide that made it unique or allowed it to succeed?
Yeah, I think that's around the people. There's just nothing like being able to get the right people on the phone quickly. To be seen as a trusted advisor is a heck of a thing. We talked about that last time. It's a long road to build relationships. And so to bring talent from Peters, First Energy, wherever they're going to come from, overnight you've got reach, and overnight you have answers, and overnight you have ideas. That was the key to accelerated growth for sure. Drove tons of fun, tons of learning, tons of success for our clients and ultimately ourselves. That's what we did right. Financial crisis takes your legs out in confidence, in outlook, in risk profile. It redefined what the banks were going to do, and lots of things. Sea change, like lots of things change. Followed just years later by commodity price volatility. You can get exposed pretty fast on if you take a minute in the middle of, we were just doing all this winning. And now say, how much winning are we going to do in the next couple of years in this landscape? All of a sudden you ask good questions and the market moves on you.
So what were you thinking? This is going to be a career at this investment bank, or were you guys hoping to sell one day? What was your thought process?
Well, I'll separate everybody else from me. I am on record of saying I fell into this ass backwards. I'm on record as saying I was fortunate to be given opportunities and run into great people. And despite my attempts to sabotage it, they kept giving me opportunities, and I'm the result of good fortune. All I wanted to do during that time was do a good job. That's all I was focused on. I wanted people to know I told the truth. I wanted people to know that they could call me and ask a question. I would give them an answer. I wanted to know they could tell me something and it would be in confidence. And all the things in building, some established and some building, and some had to be earned over a long period and some overnight, just happens. I was building myself while Tristone was building. And then when Tristone was sold, I didn't stay through the transition to Macquarie, joined the group at National Bank, who were then wanting to transition what they had been doing to something better. And so to me, that was the transition point for me saying, okay, I'm not building myself anymore. Now I'm going to apply it and flex a little bit on what I've learned and try to apply it differently.
What year did Tristone sell again?
I'm going to say that was 2009 or 10 or something like that. Maybe I'm off. I'm off by a year. I just don't know which way. Let's say it was 2009.
Did you get a sense the market had shifted and there wasn't as much opportunity for the independent investment bank?
Well, different. Not that there was an opportunity. And let me maybe I'll skip forward a little bit and then it'll make sense. And again, I'll say this is my opinion. Like somebody in a banking world, a bank world would get upset by this. My opinion is a couple things with the bank model. One is the lending business, when commodities are always stable or they always go up, the perceived risk in lending as a business is low. And so you had the bank, and National was an example, where they're lending to all sorts of different companies, but lending to a smaller junior company audience. Remember my opinion, I don't think they understood the risk that they were exposed to. And oil price shock and whatever else happens along the way, that exposes, wait a minute, like, what do you mean we're taking a loss here? And all kinds of things happen when that happened, and you don't end up taking one. Maybe you take one, but 7 other things had water leaking, right? But what happened in that time period is the lending business within the bank is waking up to the risk we were exposed to for the last period of time. What were we doing?
Did you guys lend to Tristone?
No. In Tristone, no lending. So I'm talking about National.
I see.
And I apply this to any of the Canadian banks and U.S. banks too. So in National, and I'll pick on them for no reason. They're doing a great job today. But this is my experience, is they were researching the companies that the research analysts wanted to research. The sales and trading desks were trading the stocks and the equities that they had flow in. The investment bankers were running around trying to provide advice and do deals with the companies and CEOs and executives that they had relationships with. And the lending team was lending money to whoever they wanted to lend to. And the risk management guys, not to be forgotten, would lend to whoever wanted to hedge. Often, the people that are hedging the most, that are best risk management clients, are your worst lending clients because they're ones taking the most risk. So as we entered the National in whatever, 2009, 10, something like that, really within not very much time, we started the process. And this is my opinion of the way it should work, is it doesn't have to be a perfect overlap, but let's say I want it to be 80-20 and it's probably 2/3, 1/3. Your research focus list should be the same as your biggest trading names on your desk, should be the same as the companies you lend the most to, should be the same as the ones your investment bankers spend time with. And what you're doing as a firm is building a relationship. So if Tom can't answer the phone, then I can call this person or that person, and it's the team. I can get a hold of the team. So it's no longer about the individual. And I believe that's the way it should work, much to the chagrin of the independents that look at it and say, well, the big bad banks are leveraging their lending book to say, therefore, if I lend to you, therefore, I deserve your investment banking business. And my subtlety to that, and I understand the critique of that, the subtlety to that is really, I think the ask is, if we're your lender and Tristone, to pick on them, isn't going to lend to you, which they weren't, then you can't just hand Tristone your equity business or advisory business. Doesn't mean that National or RBC should get it, but National or RBC or your lender should get a chance at it. You should be able to compete on an even scale and not be excluded from it. Just say, well, you just lend to me. Why don't you stay over there? Well, and this is my point, is there was a long period of time where that was just fine. But when you have these rocking events, remember we talked about how much they rock the independents. Well, God, I can tell you, my seat was warm and my phone was warm from how much it rocked the banks to go through these price shocks of all shapes and sizes. And you see the U.S. lending exposure to the Canadian market evaporated. That's not random. Like these banks are saying, well, look, we're making all this good money and taking no risk. And then they wake up and go, oh, what the hell? And so you have this reverberation, and I like to think, but I try not to, I don't ask around too many questions anymore, but I like to think that's a continuing focus for National. And I think it's been a continuing focus for other banks post those credit rocking events in global markets. My opinion is if I was to start or join a thing today, it would be three things. Would have to be one of three things. First is would have to be amazing people. Second, it would have to have a credit portion because it's too important. And third, maybe it just is pure advisory. Maybe it's pure advisory that doesn't come with the handle of research. Maybe it doesn't come with credit, and you just promote it as back to the beginning of ideas, expertise, and execution. And so what you need is talent. You need the best people, best relationships, such that you can say, listen, somebody calls and says, okay, Trev, we have this deal. We're working on this thing. National RBC, our credit guys, they're going to be in the room for advice, but we want to have a purely independent voice, and I trust you and I want you there. We want to hear what you have to say. But I've said that for years, haven't seen it happen. Yeah. That would be the third way that I think it could still happen.
So in 2009, when you sold Tristone, you went to the big bank because there'd been a shift in the market and there wasn't as much room for the independents anymore. You saw that at the time?
You could see it. You could see it and feel it. But let's not crown me with understanding the market completely at the time live as it's happening. Financial crisis had just happened. You had a V-shaped recovery. I take no claim on understanding what the next 5 or 10 years was going to look like. But I knew National had a plan. I knew they wanted to add some talent. I appreciated the interest, and I thought it was going to be a good fit.
Because you guys, Tristone was a success financially for you guys.
Yep.
And so in theory, you would have thought of starting a new investment bank, but the market had shifted.
I thought for me, the National opportunity was a lot of things. I never thought I would work in a bank. I always thought that I would say something stupid. To me, it was just what's the best place where I can go and do good things. But it was terribly famously, you can Google this National Post article where they actually quoted me saying, I wouldn't come here if it was just a bunch of donkeys. Like I actually said that, and they actually quoted me in the newspaper. And that's true. I thought that some real talent was coming together in National to do something interesting, and I thought I could add value.
You probably didn't have to work anymore after that time. What motivated you?
I also don't spend a lot of time thinking about that. I don't think in history I ever did. I just like spending time doing things that I like doing, and I like spending time with people that I like doing it with. I don't wake up and say, I'm an investment banker. I don't think I have ever said those words.
This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info at conatewater.com or check out conatewater.com for more details. This episode is sponsored by 360 Engineering and Environmental Consulting. 360 is dedicated to shaping a better future by championing responsible development with a forward-thinking approach. As established leaders in the site closure market, 360 provides innovative solutions to address complex engineering and environmental challenges. From safeguarding communities to preserving our planet, 360 is committed to making a meaningful impact at every step. Discover the 360 vision and learn more at 360eec.com. Circa 1990 through 2000, then up to the credit crunch 2008, there was a lot of opportunity in corporate finance in Calgary with the energy markets, but things slowed down. The financial crisis in 2008. And since then, the pool of equity raises and capital has gotten smaller, which has made it harder to start an investment bank like you guys did, or even do deals at a big investment bank. Do you think there's room in the market for another independent investment bank, or how do you think about that nowadays?
Yeah, I think, like I just mentioned, I think there's always room for great relationships and expertise and great ideas. I think that the energy business is fantastic for acknowledging entrepreneurship and ideas. There's no corner on the best ideas. So I always think there's an edge for that, but I think it is different. I think the credit market has proven to become very valuable, and the banks are now learned from their own mistakes and becoming more sophisticated on the group hug. The relationship hug, I like to call it. They're better at it than they have ever been. And so I do think there's an opportunity, has to be great talent, has to be driven by expertise, relationships, ideas. If it's not there, I have my doubts.
Plus, there's some great bankers out east at, for instance, Scotiabank, who provide a great service too from Toronto that are also competing for the business.
It's no secret that not recent history, but if you look in longer cycles, the Canadian energy business has been a large percentage of bank revenue from all different facets. It's a capital intensive business, whether it's equity, debt, all different shapes and sizes in between, and one of the most liquid transactional markets in the world. Well, that is a hunting ground for advisory, for capital markets expertise. And so it's not random. Recent history of illiquidity tests that, but that doesn't change the history, and it doesn't change the optimism for it to be that again.
What did you do the night Tristone sold and you realized this had actually worked really well? Did you go out? Did you have a nice dinner?
No. Well, I didn't. I'm sure some of the guys did. But it's weird for me because at the time when it actually happened, I knew I was going to national. So
life was good.
Well, it's fine, but that wasn't the end for me. I knew it wasn't the end for me. It was just like along the way. It wasn't the first time I had changed a job. And by the way, I wasn't putting $1 billion in my pocket.
Right.
But if it was, I would have a better answer to that question.
Fast forward today, you're involved with 4 private companies.
Yeah. So we can run through them quick, and then you pick which one, if any, you want to talk about. So I'm on the board of PointBreak, which is a private energy producer, Manville Stack, Eastern Alberta focus for now. And they're early stages, so they just bought an asset. The fundamental asset's doing great, and they're plugging along, doing the right thing. I think that's a multi-year thing funded by private equity. The Lex guys in Regina, biggest funder. They're doing great. They'll continue to do great. And the board's fantastic there too. Rok Resources is a small public thing that unfortunately the public markets just couldn't care less, it appears, about small illiquid producers, which is fine. It just is what it is. But the guys at Rok continue to do the right things, and they're smart guys and they know what they have to do, and they just put their head down and do it. I've known those guys a long time, so I trust them to do the right thing, and What I see is what I feel, so that will figure itself out. But the talent there is good, and they're doing the right things. So then Southern Pacific is again now private, used to be a public company. And that's a company that has been recapitalized out of receivership. So anybody who thinks they knew the name Southern Pacific, yes, that Southern Pacific. So we've recapitalized it out of receivership and we've been cleaning it up. So filing tax returns, and we actually just completed a 2-year financial audit in case we want to take the thing public again. So as much as it sounds fun to have spent the last couple of years doing tax returns and audits, it has been super interesting, super not fun. But anyway, we're teeing it up to do something cool with it, and hopefully we can figure it out. Spark is really a close-ended fund, for lack of a better phrase. And if nothing else, Spark keeps me thinking about capital allocation and thoughtfulness. Sometimes I laugh about it because all it does is remind me that if I put criteria and then follow through on the criteria, then maybe I would actually not do stupid things. So the difference between what happens in Spark and then what happens when I have some, idea on the spot, the two outcomes tend to be totally different. So Spark is cool and it's its own thing, but it just is what it is. Choreo is something totally different. Malcolm Adams used to work at Rok Resources and Arc Financial. Malcolm runs Choreo. Choreo is a startup. It creates, I'll say, organized, choreographed carpools for peak time usage. It is cheaper than the Ubers of the world that put cars on the road. So you call an Uber, takes a car off the road onto the road, and it's more convenient, faster, safer than public transit. And so Malcolm's doing a heck of a job putting these projects together for universities that have masses of people that come to the same place at the same time and then have a parking pinch, right? So these are the types of subjects that he's into. I'll pitch you after of getting Malcolm on here to tell the story himself, but that's what he's doing. And it has an energy flavor to it. It's been super interesting, but this is not my thing. It's Malcolm's thing. And I'm happy to help him. And however I can, that's what I do. And then I've just finished with my only not-for-profit, which was Tennis Alberta, which was an interesting experience that I'm digesting how much value I can add to the non-for-profit world, which I know sounds terrible. This is a me thing, not anybody else thing. But we took that Tennis Alberta, which I thought I would step in and say, I know in the space and know the people and whatever. But I stepped into a non-for-profit that was functionally illiquid, really, I would say marginally irrelevant, which led right into the teeth of COVID. And I think it's not a stretch today to say Tennis Alberta has fixed long-term problems, has fixed righted or wrong that happened a number of years ago, and now has a productive economic relationship with Alberta Tennis Center, which is in the southeast of Calgary. And that partnership is going to provide a recurring material revenue stream and partnership with Tennis Alberta that will change the face of Tennis Alberta for a long time into the future. And it's unfortunate that it took time to get to where it is today. But as much friction as I went through, and I'm not taking credit for this, I'll take the blame for this, is I went into it saying, we need to run this as a business. Like, it needs to be self-justified and self-reliant and all those things. And getting over the cultural stigma to where it is today, I think was an achievement. So I look at it as it's a better place today than it was before, but it left some scars on me relative to the, let's say, common sense business approach. And I'm sure I left some bruises behind too. So I was happy to contribute. I'm happy with what it is today, but I didn't shed too many tears when I did my tour of duty.
So you have a unique perspective on the private markets and in the private space. A question I've been pondering lately. It's not an accident you're involved in private companies. To what extent has being private been beneficial in avoiding government proxies, aka obscure board member requirements, accounting /HR/legal reporting, which are costly, and crowd out creative technical people and skilled capital allocators?
I think I've drifted towards situations that need my help, want my help. I've never really been attracted to situations that don't need my help or don't want my help. So I like it when my phone rings and there's something complicated. I like it when I show up and I can add value and my voice is listened to, but where I feel like I can add. The largest of public companies, the talent, like they don't need me. If I can, I'm happy to do it. Finding those just becomes harder. And so have I ended up doing more privates than public? I don't know if that's random. I think that's just the evolution. I spent lots of time covering people who ran private companies. I think it's just an evolution of relationships. I don't avoid publics. It's fine. I could see adding another, but it needs to be the right fit. I think the evolution of privates, and they've been around for longer than anyone thinks, and you can fast forward to today and you could see it coming. Some shareholders, many shareholders, especially retail, they're not interested in a 5-year plan to see the results in the year 4, right? Like we'll get there fast and we'll get there in year 3.5. I don't know. There's a lot of renters of stock out there. And so the private model being measured in 3 years, 5 years, 7 years, 10 years allows you to run a business plan and execute on things that don't get measured, don't need to be measured on a quarterly basis. And the marginal shareholder, I think, gets fussy. Even a larger fund invested in public equities takes heat when things aren't working. And you can feel that heat and you can see it, and you don't have to log in for long before you see Eric taking a beating over whatever. So all the things he's doing amazing get offset by this dark cloud. Well, that's a short-termism that the private companies don't spend time worrying about so much. So if your cost of capital is an important issue for running the business, and by the way, I've always argued, like, if energy is life, in energy, cost of capital is life. Like, I really think that's the core. Well, you're going to have a better cost of capital being public. So that needs to offset the increased cost, be it listing fees, audit this, like whatever government stuff, like pound it out. Like there's definitely a bigger cost structure in being public, investor relations, travel, blah, 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 whatever. Like there's definitely a cost. It can easily be offset for a better cost of capital being public. Okay, so now if I have an acquisition model and I want to use my equity as currency, well, it's a heck of a lot easier to be a public company where you have a proxy and a liquidity and whatever. So if I'm offering you my equity in a transaction, you're much more likely to take it as a public security than an illiquid private one, right? So there's definitely benefits to both. But over time, and again, in periods where public markets experience volatility, and you can see it post-financial crisis in 2008, there was much less of a willingness for institutional capital to play in privates, to invest in privates, especially smaller ones. Each starting company started with bigger pools of capital than smaller, product of everything getting more expensive, plays being more expensive, resource play needing more capital. These all play into it. But at the same time, capital providers are saying, listen, I'll give you 50, but I won't give you 5. Now, those things are all related. Like those are not separate incidents. So now there's lots of history of people in hindsight that maybe you'd say resume wise didn't deserve 5, never could have got 50. So when the bar goes to 50, now the bar is pretty high. So it filters it out, and it's a self-correcting exercise over time. I think so my opinion today is we've come through a phase where the capital has been lacking. So there's been interesting teams or people, ideas saying, hey, we should do this, we should do that. I got this idea, whatever. And the failing has been, I wonder if we could get the capital. And so we've seen in Calgary specific, we've seen a number of private equity funds not raise a new fund. So ARC just raised a new fund, good for them. Lex raised a new fund, good for them. But and I don't want to pick on anybody, so I won't, but where's the other 4 or 5 that were on Fund 3, Fund 4, Fund 5? Maybe there wasn't enough liquidity in an M&A market to provide return of capital to those shareholders. So they said, right, so yeah, sure, I'll participate in Fund 7. Just give me money back from Fund 6 and then I'll put it and I'll roll it in. But if I can't give you money back on fund 6, either from a profit perspective or even liquidity, all of a sudden I can't quite reach my pockets, right? And so today, like fast forward a little bit, and I feel this, but I haven't seen it yet, and this is where you might step into politics a little bit, which I shouldn't do, but I'm sure I will. I feel like you can see an end to a anti-resource Canadian government for a lot of reasons. I think that American capital providers and institutions are faster than Canadian institutions historically. I think Eric knows that. I think David Canoe knows that because they're sharp and smart and they're top of the food chain. But do I think the average generic generalist institutional guy, girl, whatever in Toronto is on top? No, I don't think they're as sharp or as quick or whatever. Today, I might make a case, and I think I could find a lot of people to agree with this, is I think there's capital for the idea. I think there's capital for the team. I think what's missing today is that A, B plus team with a great idea. I think that is coming. I feel it. But what's not happening is the M&A in the space to create liquidity for that management team to restart. So we've seen it with crew. We'll see whether crew turns into one new crew or two new crews or zero new crews. I don't know. But we need more of those. And so we've seen cycles of new companies starting. The precursor to that has usually been M&A, which has created those teams to be free to restart.
But if you've seen value in being private to avoid government proxies,
I think that's an outcome. I don't think I've ever heard someone saying, I'm going to be private because I'm going to do less governance, or I'm not going to do as much ESG. I don't think that's a driver. I think that's a benefit. But I think I might simply argue that there's a number of leaders or teams that their skill set just fits better private. Maybe they're like super technical where putting them in front of public investors just doesn't work. So why if you don't have a team that wants to be public, you don't have an asset that really can perform on a quarter by quarter basis, it doesn't fit the business plan. And now you're public, and now you're going to trade at a worse cost of capital relative to your peers. And you're not set up really to compete with, I don't want to name names only because I'm going to leave somebody out, but you don't want to, I'm going to step up and I'm going to have day one, I'm going to have a worse cost of capital than, the best 20 names in the space. Like, what are we doing here? And I think one of the complaints in the market today is there are too many names. For that reason, I feel like a lot of that is not understanding how much consolidation has already happened to get to today. I don't think you're walking around with very many C teams and B teams and assets likewise. But I think if it fits the business plan, it fits the personalities, it fits the talent, it fits the assets, I really don't think someone says, you know what, I'm going to be private because I want to dodge listing fees or whatever. I haven't seen that. I think it's just on the margin. I'm not dismissing it. I know it's an issue, but I don't think that's the reason why I do one or the other.
The argument is a lot of the best teams are run by creative technical people and capital allocators who aren't maybe the best at being in front of obscure regulatory requirements and questions from the outside in, and they should just focus on what they're good at. You haven't seen that as much.
Some people are great at it. Some people don't want to do it. I don't know. I think it fits in different categories. I just don't think it's the primary. But if you told me you were going to start a company and you wanted a currency, you wanted your equity to be a currency for your business plan, you're going to be a public company.
Why did you, in theory, you could have bought an index fund 10 years ago when you started, and you would have ended up, I don't think the average is, some of them are up 15, 16% annualized. Why did you pick private markets? Did you see more opportunity?
Well, I don't just invest in privates. I just probably have more exposure to privates than the average bear, and certainly more than larger institutional funds would have exposure to because they're just not allowed from liquidity perspective, right? So part of it is just familiarity, knowing the people, knowing where to find it. And yeah, a bit of that is history, relationships, understanding, because it's not the same. You don't get as many touch points. You don't have research analysts publishing on the name, so you don't get You don't get a number of feedback loops on how the company's doing, how the company's going to do, and call it what it is. There's not a lot of liquidity off ramps if you want to get off, right? And so it's not for everybody. So for me, I don't have a problem investing in publics. I do. I like many of my public investments, just like I like the private ones. In Spark, I have both. Choose your favorite child. I don't. I like them differently, right? Some days I say I own too much Spur, and then very quickly after I say I don't own enough Spur, right? It's
right. This podcast episode is powered by Broadbill Energy, the local midstream company that puts producers first. Broadbill Energy does things differently and doesn't just move energy. They are moving the industry forward. While others take a cut, Broadbill shares profits back with their customers because when Broadbill customers win, so does Broadbill. With a producer-focused approach, Broadbill specializes in the gathering, processing, and transportation of oil and gas, ensuring safety, reliability, and maximum value for the people who actually produce the energy. If you're tired of the same old midstream model and want a partner that works for you, it's time to talk to Broadbill. Visit broadbillenergy.com to learn more. This podcast is brought to you by Energy United. Energy United is an organization with a mission to promote practical energy policy across Canada. Energy United is building a community of Canadians that are passionate about Canada's natural gas and oil industry and are willing to take action. Energy United is driving change on issues that matter, all the way from the carbon tax to the emissions cap. Join Energy United to make a difference at energyunited.ca. All right, some current events?
current events.
Maybe we'll do Canadian M&A first. What are your thoughts? Are there many takeout targets left, and does the markets require M&A?
So my thought on M&A, you need stability. So you need to bring buyers and sellers closer together to find that zone where there's a deal to do. So how do you do that? So whether it's discount rates, whether it's commodity price assumptions, whether it's declines, whatever, all these things fit together. It's complex. You need commodity stability. Doesn't mean you need it to be high. Doesn't mean you need it to be low. You just need it to be stable. You can't have it be jumping up and down by 10% every 3 weeks. It's too volatile. You'll never get a buyer or seller to agree on what that price deck is. And I'm exaggerating a little bit to make a point, but we need commodity stability. We need capital market stability. So we can't have markets jumping up and down. If you remember, we talked about using your equity as currency. It's a delicate dance. It's too easy to look at a press release and say, oh, we used a 10-day weighted average. Well, yeah, you did, but I can tell you some bankers sweated that for 10 days, if not longer. So you need this stability to bring buyers and sellers together. And then you need, and I'm sure there's other stuff, I'm just going too fast here. You need the market to want it. So the way I measure that is the market should be telling you something as a public market security. Market is telling you by giving you a better cost of capital, higher multiple, that we're encouraging you. We like what you're doing. Keep doing it. Giving you a multiple different from somebody else, then you can use your multiple to acquire accretively. Market feedback, encouraging you, whether it is go faster, do more, whatever it is. Market giving you a worse multiple. Market saying, I really don't like what you're doing, whatever that is, right? So with a higher cost of capital or lower multiple, harder to do transactions because it's less accretive on a per share basis. And then, and this is something I look for, and we've seen it in pockets, but not nearly enough, is you want to see an M&A event, and then I want the market to respond positively. So Whitecap buys assets, almost 2 years ago now, year and a half, get smoked, year and a half later, Whitecap great. On the moment, smoked, and then it turns out to be, hold on, professional acquirers, strong capital markets franchise, trusted, deal, smoked. Now, Whitecap can survive that. But what's the message to if you were in the queue, working on a deal coming down the pipe, and you're saying, well, we're going to do a deal too. If Whitecap would have went up 10%, you're excited. Whitecap goes down 10%. I'm way less excited, right? So you need markets to help you. Now, you could have none of that support and just do it anyway. And there's some examples where companies have acquired a material size regardless, But what they're doing is they're saying, listen, our business plan is diversification. Our business plan is getting larger, more meaningful, doing all the stuff. And yes, it's going to be dilutive in the short term, but as we get bigger, more diversified, we're lessening the risk. That will increase value for everybody. And that's their business plan. So you see that too, but it's a harder road. So how do I feel about the market today? Again, I think you want to stare to capital flows. So if there's more optimism on common sense, business-minded, macro forces, I think that leads to capital flows. Capital flows leads to multiples, cost of capital. Cost of capital leads to transactional activity. Capital-intensive business, it's a decline business. Inventory requirements come up at you in different places. These things, it will just play itself out. So I feel like the M&A market has been lumpy, real lumpy. Do I think it stays lumpy? For a bit. But if you stare at things like Canadian Natural, Shell with their most recent asset swap, you say, oh, we're going to see a bunch of those. I would say, no, you're not. Doing asset swaps in big companies is tough, right? It has to be top-down driven because you can't have people saying, well, my chair is better than your chair and my wheels are nicer than your wheels. It just gets bogged down. But it's the same thing with equity combinations. It's tough to do. You need companies and shareholders and executives to say the combined entity is better. And it's better for all these reasons. In the short term, especially market to market combinations can be short term disappointing for marginal or small shareholders. But in a market like today where I don't know if it's an accusation, but it's for sure a concern. I think there's a number of companies that are competing for the same shareholders. I don't think there's enough institutional for sure, but I don't think there's enough shareholders that, like you said earlier, are still willing to play in the space and not just buy an index or buy Eric's fund or Dave's fund. Those marginal shareholders can get frustrated. And that's a tough one. But when you're competing for those same shareholders and you have two companies doing very similar things with similar assets in the same space and the same size and whatever, I feel like there's a risk. There's a multiple cost of capital drag there. And I don't think that's sustainable. So do I think that companies competing for the same shareholders are at risk to M&A? Yes. Do I think that companies and most like very recent macro or politics jumping into the queue, heavy sour? Could you see a cross-border for gas? Sure. Saw tons of it in early 2000. You say, gas, it's going to be the setup's amazing and the currency tailwinds are huge. Yes, that's exactly what happened. So you had inventory concerns, gas price going up, currency tailwinds, big transactional activity 2001 crossing the border US into Canada. For sure. Great. And you say, well, Tom, setup looks very similar. Unfortunately for me, as I've been saying that for a little while now, but now you're on the heat. Now you're on the face of a USA first program that isn't going away anytime soon. You're entering into a Canada first type of mentality, or at least like 1A. Very interesting. So if you are sitting on long resource, heavy exposure, I would think that you found your name in a couple pitch books. I don't think that's a stretch, but I don't know.
Speaking of politics, do you think a federal mandate with the Conservative government in Canada will be night and day change?
I think you can see it in the US.
Yeah.
It's night and day.
Yeah, exactly.
It's night and day. Do I think you're going to see a night and day difference in Canada? I hope so. I'm optimistic. But even if you don't see as much of a change, do I think you're going to see a change? Yes. But do I think you're going to get Energy East? No. Do I think you could triple TMX? Maybe. Northern Gateway? Maybe. Could you go south more? I know people like say, oh, we got to diversify away from the US. Well, maybe. But maybe the grown-ups in the room could just say we're always going to be living next to each other, and maybe there's a short-term issue we need to deal with. Pace of immigration, border security, drug flow. Those seem like short-term issues that says, okay, if I'm about to sell my house and I know that I have a leaky roof and I know that my doorbell doesn't work and I know that this stuff doesn't work, and I say, you know what? I'm not going to fix any of those things. And then the realtor shows up and says, we should fix some of these things. And I say, I'm not going to fix those things. And then somebody shows up and says, well, Trevor, here's what I pay you for your house. Minus, I know what you were asking, minus $500,000. And you say, well, that's ridiculous. I should fix this stuff myself. And I would say, yeah, you should have before you even lifted your house. Once you fix that stuff, you say, okay, listen, all the things you complained about in the house, I have fixed those things. And now maybe you can have a real conversation about the relationship or a transaction or whatever without talking about the doorbell that doesn't work. But if you get lost in this doorbell conversation, you'll never talk about the house. And so to me, the way I think about it, and I am not trying to put this on anybody else, remember, I'm not trying to, this is not a preach. I don't get lost in, but Orange Man makes me sad. Like, I don't care. There's a short-term issue that is under our control. We can work together with the U.S. to deal with it. There's a longer-term issue that we're sitting next to the largest economy in the world that is going to be on a likely 12-year cycle, at least, of America First. And any federal direction, leadership, whatever, I think to ignore that and say, well, we'll do what we want to do, and that's irrelevant to us. And don't get me wrong, like, buy Canada, great, go Canada. But booing the anthem and Orange Man bad, and all he wants to do is buy Canada is just as counterproductive as Trump calling Justin the governor. Well, that's unhelpful. That's inflammatory. It's personal. Things have led to that, right? So to me, I just separate into there's a short term, there's a long term. We need to do both. And I hope that the divisiveness can lessen and we all can work together to deal with that short term issue and the long term issue. But I think you need to have people that recognize that the decision makers in the US are actually the people you want to go visit with and not like somebody's VP that didn't even get elected 8 years ago. Maybe that's not the good use of time. And so to me, that's just the relationship of the art of the deal or just how you get to a deal anywhere at any scale it's a relationship thing. Focus on the relationships, build the relationship, build the trust, pump Danielle's tires. But look, it's not just me seeing it with my own eyes. Like this is like, that's leadership. Going down and meeting with people that aren't decision makers, it's exhausting to watch it. We can do better together, but I think we need less divisiveness. I think that comes from more consistent information that everyone's sharing and a place where people are focused on baseline issues from common sense, and then we can branch. But I don't believe that we're going to wake up tomorrow and say, oh, we're going to jam Energy East. I don't think you're getting there overnight.
Do you think that energy will be okay even with the minor tariff? We've got a nice exchange rate in our favor and that the U.S. is a big consumer and that they need Canadian oil regardless?
I do think that, especially for heavies, right? So I'm totally generalizing, but if a refinery is going to run on 30 API or something like that, well, the U.S., even under a drill baby drill scenario, even if you bought that, is going to produce more light oil. So they're going to produce more 40. That means they need 20 to get to 30, which means you need a heavy source. And I think from a U.S. perspective, despite the rhetoric, available, secure, reliable, affordable, all checks Canada for that. But I don't think it's a blanket. I think that different commodities within the energy spectrum need more infrastructure. But even like on the gas side, data centers solve it, LNG solves. Like there's all kinds of levers that solve. But in the short term, modest tariffs on energy. If you're going to have tariffs, you're going to have a currency that offsets the tariff. I don't think it's random that the energy tariff was 10% and the rest of it was 25%.
Yeah. But the idea is that it's an established grid and buying patterns, and that a tariff may hurt a little bit, but you can't just find certain grades of Canadian oil overnight. And maybe it's not as big as a worry as some people think it is.
My experience in the last days and weeks is I've come across very few people that can just separate the long-term from the short-term issues.
It's not going to crush the industry.
Correct. But that's public. Look, when you have illiquid or less liquid public markets, if you use that as a proxy, where there are not a depth of institutional participants in the market, you are doomed to be reliant on retail as the marginal shareholder. And bad things create these pockets. So can you have periods of short-term volatility where I own Meg. Do I lose my mind when it goes down 4%? No, because I wasn't going to sell it today or tomorrow. Do I lose my mind when it goes up 4%? Do I sell it when I went 4%? No, I didn't sell it when it went up 4%. But that doesn't mean it's not going to go up and down by 4%. That's part of the plan.
Well, that's over an hour. I don't know. Do you want to touch on anything else?
Well, I do. I have one thing. Totally off base is I want to challenge everyone that comes after me to nominate somebody to do the podcast.
Okay.
So today is Jim Pasika's birthday. So happy birthday, Jim Pasika.
Happy birthday, Jim.
Jim would be a wonderful podcast participant if he would be so inclined. He was a fantastic securities lawyer I worked with multiple times. Okay. And so I'll nominate Jim, and selfishly I'll nominate Malcolm running Choreo because I think you'd really enjoy it. And Malcolm loves to talk. Awesome. He might be the one that sets a record, but he's got a cool story. He's having lots of fun, and I think you'd enjoy hearing about that too.
Well, we covered a bit of Tristone, capital allocation, private markets. I think that's everything we wanted to discuss. So thank you.
Thank you for your time. I appreciate the opportunity.
I really appreciate it. We'll end the conversation there.
Very good.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca where more episodes are yet to come. You can also subscribe to the podcast where your token of support is much appreciated. Until next time, happy coffee drinking.